Good morning, everybody. Thanks so much for joining me this morning. This morning, it's April 1st. It's April Fool's, so just ignore anything I have to say today. You never know these days what people will tell you on April 1st. But we all know that Max will be straight with us. Max nailed it last week. He was bullish, and the market had a good run. I asked him this week is kind of neutral. I think the market's going to go sideways for a little bit. That's because Fed Chair Jerome Powell on Friday now seems to be in line with other Fed members recently, basically saying that they need more time to get more confidence that inflation's going down. And meanwhile, the economy is doing so well, it's buying them lots of time. There's no rush to lower interest rates as long as the economy is doing this well. So that's consistent with the view I've had as well, that we probably won't see a rate cut or two. We'll probably see maybe 2 rate cuts, but they may not happen until November and December. I know everybody says the Fed's not supposed to be political, and Fed officials say that, but the reality is if there's no particular rush to lower interest rates, and we've got 2 presidential conventions over the summer, why rush things, and certainly why do it right before the election? So I suspect if we're going to get it, it'll be 2. And I'm not even that convinced that we're going to get it. Again, it's my view that interest rates are back to normal. The economy is functioning normally with interest rates back to normal. So there's no particular reason to lower interest rates. And by the way, from the point of view of the stock market, I think that's the ideal scenario because if the Fed starts lowering interest rates here, we're going to see valuation multiples get even more bubbly. As it is, the forward PE of the S&P 500 is 21, and that's obviously relatively high, quite high. Back in the tech bubble, we got up to 25 on the forward PE. So I'd like to see that forward PE just kind of stabilize here and the market go up on earnings. Speaking of earnings, another earnings season is about to start. It's April. April is the month where we're going to get lots of earnings reports for earnings in the first quarter. And I am absolutely sure, there's no doubt in my mind, that almost every conference call, every management will say, utter the word AI or the phrase artificial intelligence at least once, if not multiple times. So I'm not sure that AI is going to be able to continue to drive this market higher because everybody's going to be talking about it. It's already kind of baked in the cake, fully discounted. I've come around in my thinking to thinking that while AI is artificial and it's not intelligent, as I've said before, and it is prone to making mistakes, I think the AI that is open to the internet is just going to be open to a lot of junk. And there's going to be more junk more junk created by AI. However, AI software that is internally fenced off, managed by companies, and fed just the company data and nothing else, or whatever else it's fed, is very carefully controlled, and it's just not kind of an open source thing where the artificial intelligence program can go wherever it wants to learn whatever it wants, as long as it's forced to learn the lessons for the specific to the companies. It should be a big productivity generator. So I think it's important, and I think that the roaring 2020 scenario that we've been talking about just started to get discounted back on November 30th, 2022, when OpenAI introduced ChatGPT. But again, as I've related to you before, I tried it for $20 a month to make sure that I had the very best ChatGPT, and I tried to see if it could write the morning briefing, and sure enough, it did. But it was full of errors that I needed to correct. So that's where I sort of cooled off to my enthusiasm for AI. But again, upon reading what it is capable of doing and what it is doing, I think it should be a game changer on the productivity story, which is fine by me, of course, because the Roaring 2020 story is all about productivity making a big comeback, productivity growth, and productivity growth being the fairy dust for the economy. It's a win-win-win situation. You get better economic growth, real GDP, you get lower inflation, real wages go up, profit margins continue to go up. So that's my story for the rest of the decade. Again, I'm not telling you there aren't alternatives and they aren't possible. Still watching out for that great inflation of the 1970s scenario. It doesn't look very credible anymore, but all it would take would be a major disruption of oil supplies in the Middle East, and it could be very reminiscent of the 1970s again. So that's certainly something to worry about. And I keep getting challenged by people saying, well, I don't talk enough about the debt to GDP ratio and interest expense going up by the government. I do mention it occasionally, and I tell you all that I'll worry about it when the bond market seems more worried about it. The bond market was very worried about it from August to November of last year, but then Janet Yellen, in a very smart way, cut back on the supply of notes and bonds and issued more bills, and that seemed to calm the bond market down, as did the perception that the Fed was done raising rates and the increasing chatter about when they might lower rates and how much they might start lowering rates. As you know, at the beginning of the year, there's a lot of talk that there would be 6, 7 rate cuts starting in March. We didn't buy it. We didn't understand where that was coming from. And looks like the market's in agreement with our kind of scenario. So on Friday, Fed Chair Powell gave a little talk in which he indicated that he was basically a little bit more hawkish than dovish in terms of saying that as long as the economy is strong, there's really no rush to lower interest rates until they're fully confident. Somebody else just walked in. I guess that's Bailey. And so we got a full house here. By the way, speaking of full houses, I think next week I'm going to have a surprise for you. I won't tell it to you, but it does have something to do with King Charles Cavaliers. Speaking of King Charles Cavaliers, that's the three we have right now, and some of you may be getting used to the idea of Max on the market. We'll keep a record of how well his predictions go, but in some ways, Max seems to have been influenced by me. He's a bulldog, so we have to factor that in when we hear his forecasts. Meanwhile, speaking of bullish, the Chinese situation looks a little less bearish. The China PMI, manufacturing PMI, increased to above 50. I think it was 50.8 for manufacturing PMI. That's the first time it's happened in several months. I think actually since the pandemic closures, really, there was one instance where it was just briefly for a month up above 50. So maybe this is just a brief revisit of a number above 50. But I'm thinking that there's more stories coming out of China that the government is getting frustrated that they can't seem to be able to stimulate consumer spending. They've got a property bubble. They need growth to come from somewhere. So guess what they're doing? They're going back to the old model of stimulating manufacturing for export. And what that means is that they might get some economic growth out of it, but it may very well be a setup for dumping the Chinese products on the global markets, not just tchotchkes, as we say here in New York, little trinkets and toys, but also electric vehicles and so on. China's already really given German manufacturers of electric vehicles and vehicles in general a run for their money. So there could be more trade tensions, and there could actually be deflation. So I'll be watching commodity prices. We are seeing the price of oil picking up somewhat. That could be the global economy doing better because China's doing better. I'm more inclined to think that that's not likely, and it's more likely that the price of oil is building in a geopolitical risk premium in it, given the instability in the Middle East. Copper's been up a little bit. Our CRB raw industrials Commodity prices hasn't done much. So all in all, the commodity prices are telling us that the global economy is still kind of muddling along. Let's look at some of the charts here. And I didn't ask my staff to work this weekend. It was the Easter holiday. I hope you all had a great weekend. Here it was nice and sunny, so we certainly enjoyed it. Spring is here, or the gardener is here, so I know that spring is around the corner. First time he's come and putting out some of the lawn furniture, so we're looking forward to spring. But enough of my chatter here. Let's get to the meat of this morning briefing that you'll get this afternoon on an advanced basis, and it's dated April 2nd, so it's not the April Fool's edition. But the title of the morning briefing is The Amazing Flying Machine. And what I'm referring to is GDP. The economy has done amazingly well, despite all the talk about a recession. It's been remarkably resilient. We've had rolling recessions. Today, this morning, we had the MPMI, not just for China, but we also had the MPMI for the United States, and it was back above 50. And again, I don't think it's done that since sometime in 2022. So I do believe that we did have a rolling recession in the goods industry, primarily because people went in a buying binge after the pandemic, and then that binge ended. But what's interesting is consumers didn't just like suddenly retrench on goods and move into services. They actually kept buying at the same pace. The consumption of goods in real terms remained at a record high, even as the binge ended. So it's not like they stopped buying; they just stopped binging and stopped going up. And then they pivoted over to services. So the economy is doing great. This is the Atlanta Fed's latest forecast. The consumer numbers were revised up from 1.9% to 2.8% for the first quarter. That shows the consumers are still going strong right through the first quarter. I remember in the fourth quarter, there was talk about consumers running out of excess cash. There was talk about consumers being challenged by having to pay their student loans again. And yet we had a very strong fourth quarter number that was revised up from 3.2 to 3.4% with a big revision on the consumer side. That followed an even stronger number back in the third quarter, okay numbers in the first half of last year. And then, so that's not a hard landing, that's for sure. It's not even a soft landing, it's no landing. The economy is still flying. And this number suggests that this amazing flying machine is still flying. This is 2022. And when you think about it, it's not that bad when you consider that in the first half of the year, we had the energy shock worldwide, the Russia invading Ukraine, interest rates starting to soar. We had 2 negative quarters, but that did not add up to an official recession. We were arguing that if you get an official recession, you really need the index of coincident economic indicators, which is monthly, to go down for a while, and that wasn't happening. It was going up to record highs. So when we look at the year-over-year percent change in real GDP, we can see that in the fourth quarter, on a year-over-year basis, it was up 3.1%, which happens to be smack dab the average over time of real GDP growth going back to the late 1940s. So the economy is flying high. Back here, there was a lot of talk coming out of the great financial crisis that the economy was going to fall into recession because we were at stall speed. The economy was growing around 2%. We disagreed with that. We thought that would be the new normal for a while, and that the stall speed thesis was wrong, and that worked out for us pretty well. This is just a quick chart here of the importance of consumer spending to the economy in current dollars. You have to do it in current dollars. If you do it in real, you get index comparison issues. But clearly, the consumer is important, accounting for 68% of nominal GDP. And this is an interesting chart, right? It shows you how we've become more and more services oriented, less and less goods oriented. And the turning point actually occurred back here in the 1970s. So more and more services. Healthcare has been an important source of that growth, by the way. But I think this is a picture of a fairly successful economy. As the economy gets wealthier, the standard of living go up. People tend to kind of be maxed out on goods, and they tend to turn to more and more services. And so that's, I think, a good-looking chart. This is the year-over-year percent change in real consumption spending, up 2.7%, a little bit below the average over time of 3.2%. So consumers are doing a Goldilocks. They're not too hot. They're not too cold. They're doing just fine. And they're certainly not showing any signs of retrenching and leading us into a recession. This is a fun chart, interesting chart, important chart. It shows real personal consumption expenditures per household. So we simply take the GDP data on consumption, divide it by the number of households. And it's kind of interesting that this has been going up at a rate of 1.8% per year, which means that the standard of living doubles every 40 years, which is exactly what it's done here. It's doubled. So remember all this ridiculous talk about an American standard of living being declining. I'm sure I'm going to get some feedback from people saying, you know, I don't get it, that people are suffering. I know that. I know that there's a lot of people that aren't doing well. But when you take the macro data, and this is consumption per household, so it's the average consumption per household. Look, the rich don't eat much more than the rest of us eat. Maybe they buy bigger houses and more expensive cars, but there aren't that many of them. And I think this is fairly reflective of the standard of living of Americans across the board, even allowing for the bias that some are doing better than others. But as you can see, real consumption per household standard of living is basically been running at a record high here. Took a dive back here, but it's gone up pretty dramatically. And now, on average, the average household spends $128,000 a year on consumption. And it's a household measure, so it's not per person; it's per household. And consumption should be measured per household, in my opinion. Meanwhile, capital spending, remember all the talk about the tightening of monetary policy, tighter credit conditions are going to depress capital spending. Guess what? All-time record high for private non-residential investment in real GDP, okay? So it doesn't include residential, and it's just the private sector, not the government sector. All-time record high. Look at that number. Beautiful. It brings tears to my eyes. $3.3 trillion. Now, when you look at the breakdown of late, you can see that intellectual property, that's the blue line, has been very strong. And a lot of that is software, but it's also R&D. Equipment is a mishmash of transportation equipment, high-tech equipment, and all that. That's been kind of stagnating, but certainly has recovered from the pandemic. And this is starting to lift. This is structures. And what's really taken off here is the onshoring of production and the tremendous surge in the construction of manufacturing facilities. Here's a little bit more detail on high-tech capital spending. Here's the software. This is current dollars, all-time record high. Research and development stagnating, but at an all-time record high. And then here's information processing equipment, basically computers and communications equipment. Here's the happy story on structures. This is manufacturing structures in the real GDP number. We looked at that green line before. That includes this one. And this is the nominal version, which was actually revised, what was actually updated this morning, if I got it right here. No, I didn't get the February number in there, but I think it rose to another record high. On the trade side, because of the pandemic, the end of the lockdowns, we had this tremendous buying binge for goods. A lot of them were imported. The trade deficit widened, so that was a drag on economic growth. And yet the economy continued to grow without a recession, despite that drag. And then as the buying binge cooled off, we saw that the trade deficit started to narrow, and that's actually been a contributor to economic growth. These are exports and imports. When you look at it, they confirm that the global economy is not doing so red hot. The U.S. Exports are kind of flattish. Imports are kind of downish, which would suggest that the U.S. economy is weak. But as we've seen from the look at the various components of GDP, it's doing awfully well. Inventories, we've had some inventory disinvestment. We went from here to here. That's a negative. So real GDP would have been stronger if it wasn't for that. And there's a number for that. It's called final sales. Real final sales actually rose 3.9%. So real GDP, 3.2%. Real final sales, 3.9%. This is a strong economy. As Powell said, with the economy this strong, we don't have to rush here to get to be confident that inflation's coming down. Profits also came out with the latest GDP number. I think they always come out with the second revision, and all-time record high for corporate profits. Dividends down a little bit, but near a record high. Undistributed corporate profits not at a record high, but they're up. So you add these all together, and you got a record high in corporate profits. And this is what's important. Remember, I just showed you that capital spending all-time record high. How could that be with interest rates so high, with credit conditions tightening? Well, it's because corporate cash flow is at an all-time record high. Remember, we were looking at $3.3 trillion on capital spending. This is corporate cash flow at $3.5 trillion. So there's plenty of corporate cash flow, as you can see. And this just compares the corporate cash flow to non-residential private fixed investment. I misspoke. It's 3.8% in current dollars. We were looking at real. So it's 3.8% in current dollars. So there is a financing deficit, but it's a piddling $300 billion. I mean, that's chump change in the capital markets, and it's easy to raise. Meanwhile, the consumer keeps doing what they do best. They continue to consume. Let me close the window here so that we don't hear the. One problem I always have in the spring and the summer is the noise from the blowers. I don't know why, and nobody's invented a silent one yet. But speaking of silent, Bailey and Max are having a good snooze over there. Nature is so symmetric. I mean, they just kind of like form a triangle. I don't know how they figure out to do that, but it's kind of nice to look at. So, anyways, the consumers keep doing what they do so well. They continue to consume. And one of the reasons for that is that for all the talk about excess savings running out and the consumers would have to start to increase their savings, hasn't happened so far. They're still kind of very low on the personal savings rate. And I think some of that has to do with the fact, I love this chart. This is my generation. It's the baby boomers. The baby boomers. This is total household net worth. We've discussed this before. $156 trillion. Some of you have bearish and pessimistic colleagues or family. Give them a copy of this chart. It's a beautiful chart. It shows that the baby boomers have $76 trillion of that net worth, richest generation ever. And they're not going to spend it all. And some of it's going to trickle down to the Gen Xers and maybe even to the millennials. But this gets to one of my theses, is that the wealth inequality certainly does exist in our country, as it does in every country. The rich tend to be extremely rich. But what this chart also shows is, don't forget about demography. Older people tend to be richer than younger people, as Spock once said, not Dr. Spock, but Spock from Star Trek. Live long and prosper, right? I did it this way. I think I've shown you that before, that I can do it. Anyways, live long and prosper. And that's what the baby boomers have been doing. They've been living long and prospering. So they've got a tremendous amount of wealth. And now that my thesis that they're spending it is sort of corroborated by my observation that when you go to a restaurant, especially ones that are a little bit high end, or maybe even not. I mean, no, I'd say restaurants across the board, you're going to see more gray hair, more baby boomers eating out. Kids are gone. And that doesn't make sense to cook at home, so they're eating out. And so you can see that in current dollars, food and beverage food services, which is the blue line. Did I get that right? Yeah, that's total food, 1.2 trillion. There it is. That's food. It's the green. Sorry. So food services is restaurants, And you can see that's at a record high. I guess it's kind of back to trend, but it's at a record high. So they're eating out a lot. What else are they doing? They're having fun. They're going gambling. They're going to amusement parks, recreation. We all are. But again, look around. You'll see probably more gray-haired people, baby boomers like myself. And then they're traveling. So here's air transportation. Look at that. I mean, just straight up. Some of that could be pricing, of course. It's got become more expensive, but they're paying the price. So this is air transportation. This is hotels and motels, and that's the total. What else are they doing? Well, just to make sure they can keep up this amazing pace of recreation and eating and traveling, they're checking in with their healthcare providers, and so that's at an all-time record high. And guess where all the employment has been in this strong economy? It's been in these areas of the economy, so it's kind of feeding on itself. Meanwhile, what about inflation? Well, what about it? I don't have a problem with it. Some people microanalyze it. They find that legal insurance fees, auto fees, they're all going up. I get feedback from people telling me inflation hasn't come down. The cost of living is going up when you look at it as an individual. I grant that, but from a macroeconomic standpoint, from the point of view what the Fed watches, I think the Fed looks at the overall inflation numbers, and they do slice and dice it to a certain extent. But there's a limit to how much you want to, look in the weeds, because you could kind of get lost there. And it's interesting that the consumption deflator core in the GDP numbers has been 2% at an annual rate, 2 quarters in a row. That's pretty impressive, and suggests that the year over year is going to continue to come down. So we're heading in the right direction. That magic number 2 pops up here in the year-over-year percent change in consumption deflator, excluding energy and housing. The CPI less energy and shelter, 2.2%. So take out energy, take out shelter, which has been a slow-moving component of inflation to the downside, and you get that most of us are already living in a 2% world. Here's just some more data showing, well, it's not that simple. If you do kind of slice it and dice it, you find some reasons not to declare mission accomplished that we're at 2%. So you can do the core inflation for the PCD, 12 months, 6 months, 3 months, and the 3 months is shot up actually to 3.5%. But you look at the history of the thing, the 3 month tends to be pretty volatile. I still think the Fed looks at the year over year, and the year over year has got a 2 handle on it. And I think it's going to continue to head lower. This is goods. We still have deflation for durable goods. We got no inflation for non-durables, so that continues to be an important source. And China is exporting deflation. What else do we have here? This is another slice and dice that the Fed likes to do. They look at goods, so they're not troubled by goods. They look at housing. They're not troubled by that because they acknowledge that it's a slow-moving indicator, and that current rents or inflation is much lower. On the other hand, he hasn't really mentioned it recently. Maybe he's not lost his interest in it, but Fed Chair Jerome Powell kind of got us all focused on the super core inflation rate, which is services, excluding energy, excluding housing. There it is there. And you can see that that super core rate is coming down, but doesn't have a 2 handle on it. What else? I think that's enough. You can look at this. Well, I'll give you a quick chart. This is the super core inflation rate. And again, if you look at the 3 month, it's 4.5%. So there's, if you want to worry that we haven't gotten completely to 2%, you can find it there. But again, we're not arguing that the Fed should be lowering interest rates anytime soon. Okay, so let's see what we have here. We have a nice crowd. I appreciate that you folks tune in. But I do try to respect your time, and we got a couple of questions here. See what I can run through here. Let me switch glasses here. See if my audience is okay. Yep. All right. So, Agnes, hello. I had 2 quick questions, if I may. One, with China PMIs overnight and very strong ISM manufacturing today, how likely is it this commodity rally becomes a demand-led inflationary one, then supply-led the inflationary one. Yeah, I mean, the PMIs, good point. I mentioned them separately, but we do look at things globally, and from a global perspective, China is doing better, and the U.S. is doing better on the production side. So I think the rolling recession in the goods sector seems to be over. But I don't think we're going to get a buying binge on consumer goods. They've been continuing to buy a lot of consumer goods, just not at a new record high. So I don't know. I'm looking at commodity prices. I think maybe they've bottomed out, but I don't think they're going to signal that things are rip roaring to the upside. I think again we're going to have a lot of deflation coming out of China on the finished goods. But and then the other thing is maybe this means more demand for copper and things like that. But meanwhile, it doesn't mean more demand for copper from their property market, and it also means that iron ore demand has been weak. So I'm watching iron ore. I'm watching copper as among the most sensitive indicators of the global economy, as well as oil. And oil is a little confusing whether it's geopolitical risk or whether it's the economy doing better. But let's put it this way: the economy is not doing worse. Take one. I think you had another one. Your baseline Fed cuts are in November, December. Don't you think is a problem for the Fed to deliver the first cut right in the middle of election campaign? No. It's right after the election. It's November, December. I mean, I don't think they're going to do it in the summer, which is in the midst of the election campaign. Steve, assuming the Fed does not lower interest rates this year, what do you see that doing to the housing market and overall economy? I think people acclimate to reality. We've gone from mortgage rates around 3-4% to mortgage rates around 7%. At first, it's a shock, and then as people realize that we're back to normal and it may just be here, and there's not going to be some amazing opportunity to do this at a lower rate. And meanwhile, you really want a house, you don't have the down payments, so you go to your baby boomer parents. You ask them to help you with the down payments and the mortgage. Talking from personal experience, which is very helpful in our business, I think. But all in all, I don't think, I think the rolling recession in the single family housing industry, I think that's over. We may start to see a rolling recession in the multifamily because of overbuilding leading to lower inflation on rents, which is a good thing. Okay, Chip, revisiting inflation, the burgeoning federal deficit spending and obligations exceeding $1 trillion. Consider California's minimum wage for restaurant workers rising to $20, as well as onshoring and nearshoring practices. Is the 2% target realistic, or should we anticipate a higher rate due to protracted inflation? A great question. I'm glad you brought up California. I mean, that's insane. My daughter had a bistro in Sonoma a few years ago, right before the pandemic, and she fortunately got out. Her bistro's in Petaluma, California, and the town raised the minimum wage to $15. And I've always told her the retail is great, except you got to deal with the public. And I think she got a little wary of dealing with the public. And then just managing a business in California where your costs are going up like that just wasn't worth it. So she shut it down. But if she hadn't, she'd be shutting it down now because $20 an hour is a killer for a lot of small businesses. So we'll see what impact that has. It could depress economic activity in California, and that's an important component of the overall economy. But it's wacky kind of stuff. But that's what happens sometimes in the Golden State. I'll take one more here. What do you make of the full-time highs hit by gold, Bitcoin, et cetera, as a generally strong U.S. dollar is measured? Yeah, I think the record highs in the look. It's not. People were saying that it's a very narrow market. Well, I think by now that notion has been buried. We believe that it wouldn't broaden, and it has for the U.S. stock market. But look at the stock markets around the world. It hasn't exactly been just a U.S. Phenomenon. For one reason or another, global stock investors see a bright future. That tends to be our bias, but I see a brighter future for us than I do for China, and which of course stock market's still depressed. But what's gotten Europe so excited? Anyways, that's pretty broad. But this is why I am not rooting for the Fed to lower interest rates, because I think that would start to get us into a 1990 scenario of irrationally exuberant valuation multiples. If there's a segment of the market that wants to play Bitcoin and gold, that's fine. I've never provided any useful information in that area. I need dividends, interest income, rents. I need something I can do, get a present discounted value on. But it's certainly a sign of plenty of liquidity. And, this notion that financial conditions that the Fed is remaining restrictive is it's kind of ridiculous when you look at the financial conditions. They're obviously very, very easy. So again, why lower interest rates if you feel it's restrictive enough to keep inflation coming down, which I do think will come down. And I think goods inflation will continue to deflate. And I think we'll even see services inflation deflating. But again, I'm in the roaring 2020s productivity camp where productivity brings inflation down. I'll take one last one. What are your top sectors for the remainder of the year? Same ones, technology still. Maybe you broaden out into smaller caps. The large caps and mid caps have already had a heck of a run. Then industrials, they've also had a run, but I'd stay with them. Financials have had a run, but I would stay with them. When I talk about technology, I talk about communication services as well. But I think this is becoming a very broad bull market. I think healthcare has been a laggard, and it does some catching up. We've seen some interest in biotech, so that may be the case. So all it would take is that we finally get some real substantial evidence that AI is making a big difference in some areas of the economy, like healthcare, and that could fire up these stocks. Well, you've been very kind to stay with me for 36 minutes. I appreciate that. Let's do this again next week. And yes, we still have Bailey taking the snooze there. And look for a surprise guest next week. Bye-bye.